How does blended finance make a transaction less risky?
There is a systemic undersupply of finance and investment for projects in low and middle income countries, estimated at around 2.5 trillion annually. This is a huge number, but not large relative to international capital markets estimated at 220 trillion and global financial markets at 340 trillion. But very little of this financing and investment makes it to developing countries. There's many challenges why, but the two most significant are absolute level of risk and the risk-return opportunity. Simply put, private sector investors see investment in developing countries as too risky. Blended finance exists to meet these challenges. At the core, blended finance funds from development-funded organizations absorb risk in a manner that will mobilize the private sector investment, such that the private sector investor will now see an acceptable investment from a risk and risk-return perspective. Now, one of the significant benefits has been the difference between perceived risk and actual risk. The actual risk that has materialized over the last 25 years has been much lower than expected. Therefore, the development capital has been absorbing this risk, but the difference between perceived and actual risk means that the capital has actually been preserved. So at the end of a blended finance transaction, often it's a win-win proposition for the providers of capital, but most importantly, a significant gain for the people living in low and middle income countries.